Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We have a special panel for you on tap today about the growing influence of ESG investing. Joining me at MarketSite today, we have Evan Harvey. He is the Director of Corporate Responsibility at Nasdaq. And we also have from FTSE Russell, Alec Young. He's the Managing Director of Global Markets Research. And Tony Campos is the Director of Sustainable Investment. Gentlemen, thank you for joining us at MarketSite today. And Alec, I'd like to kick it off with you. Why is there such a big trend right now? What are the macro factors leading up into this push for ESG investing?
Sure, Jill. It's great to be with you. I think there's several high-level kind of global macroeconomic forces that are driving increased ESG adoption among investors. The first thing would probably be just shifting social norms with some younger people globally, millennials, different social priorities. We're seeing increasing regulation shifts that are more open to incorporating, environmental, social governance concepts. We're also seeing technology and data availability really increasing, and those are things you really need in order to evaluate companies in terms of ESG. You need access to information, and the incredible improvements that we're seeing in technology and ability to harness and interpret data are really also enabling increasing ESG adoption. And finally, I think climate change is definitely a factor that people, I think, increasingly recognize. So to a certain extent, there's a certain amount of societal inevitability about ESG investing, especially when you're thinking about long time frames, 20, 30 years. I think it's hard to envision going about investing without any thought for ESG.
I'm going to ask you the same question as well, because this is what you do for us at Nasdaq. How have you seen the industry evolve over even just the past 5-10 years?
Well, I think that we're seeing on the company side, in addition to what Alec has already mentioned, is some other drivers that are bringing ESG to the forefront in terms of company management. You've got this rise of this new kind of manager at companies where they're data-driven. They're looking at new signals of performance, things that are sort of outside the traditional bubble. And so that's where ESG fits into their mindset. And then you've also got this emergence of this discipline around enterprise risk and board management of enterprise risk. And increasingly, you're finding companies that have oversight for climate change in particular, but other social and governance matters at the board level. So they're including sustainability and ESG in that oversight role.
Well, Tony, how are ESG factor screens, how are they being added to market benchmarks as this continues to evolve?
Yeah, I mean, I think certainly asset owners in particular are looking at this issue, and there's a common perception that sort of Europe is leading and driving on this. I think Asia and North America are certainly following quite closely and increasing their attention in the area. One of those areas is around benchmark creation and passive adoption. So certainly among the largest asset owners, there's a huge amount of passive assets. And I think traditionally ESG integration may have been thought about as an active manager integration pursuit. So looking at more information factors, some of the data and technology drivers that Alec was referring to. But on the passive side, there's a way to build some of this information into benchmark construction and both for the purposes of benchmarking, but for passive allocation. So you can actually, in the same way that you might reweight or seek exposure to specific risk factors, you can do the same from an ESG perspective. So the techniques and sophistication with which investors are looking at that is sort of improving every day.
Well, Alec, let's go back to you and talk about some of the myths around sustainable investing. What are some of them that's out there?
Sure, there's definitely some common misperceptions out there. One is that it's quite a narrow space and that all the companies are in the sort of green energy area. But when we really look at, especially a lot of the environmental aspects of ESG investing, we're seeing a lot of diversity across cap sizes. So it's not just small caps or mid caps, large caps. There's good breadth across all of them. When we look at the sectoral representation of a lot of these factors, we're seeing that it's quite deep. If we look at the market cap of all of what we would call green economy type of sectors, so all of the environmentally companies that we score on an environmental basis, and we compare that to the market cap of broad indices, we're finding that that grouping is competitive with things like retail and a lot of really large established businesses. So I think the opportunity set is more diverse than people think, it's larger than people think, and it's more global. It's definitely not unique to any one region. So I think those are probably some of the big myths that are out there.
Tony, I would imagine that companies that really focus on ESG outperform others that don't. Do you see that within the ETFs that focus on ESG or the indexes, that they outperform relative to companies that don't focus on governance?
Yeah, so there's definitely a range of performance outcomes where we've seen some of the strongest outperformance, and in fact, as Alec was referencing, some of the environmentally thematic benchmarks that we calculate that either focus on subsets of the universe that look at companies bringing green solutions to the market, or integrating sort of, let's call it, a wide range of climate-oriented strategies into both their operational risk management as well as their product offering, strong outperformance across all variations of those. So one of the important things to keep in mind here is that there's a range of approaches. When we talk about ESG, sustainable investment, there's all sorts of different ways investors might actually implement those strategies, ranging from stewardship and engagement through to exclusionary or divestment-focused strategies, through to more integrated, holistic approaches to that are a bit more subtle in the way you might incorporate some of the weightings and allocations. And certainly in the green thematic, we see outperformance across all of those approaches.
Well, Evan, there certainly is desire out there. Investors want to be part of the ESG movement. Do you think there's more pressure on public companies to disclose how they're managing their ESG strategy?
Yeah, certainly. I think it mostly comes from investors right now. I mean, there's some regulatory pressure in Europe and Asia, as we mentioned, but it mostly comes from investors. Traditionally, it's been the SRI space and the ESG thematic space, but now it's mainstream, like BlackRock and other investment institutions that talk about this pretty prominently. But then there's also these other drivers in the space that are affecting companies too at the operational level. Supply chain. They're being increasingly pressured to disclose on ESG in order to qualify for business and to win bids on contracts. There's some data providers who are trying to clean up the space and get better, cleaner calculation methodologies for the metrics that we actually drive decision making. And then last but not least, we don't want to forget the social capital piece of this. There's a piece of this that appeals directly to current and prospective employees, and so the talent war for that talent is increasingly hedged on ESG performance.
Right, and I think it's interesting that when you talk about talent is being driven to that space as well. What are some of the parameters when you look at a company to decide that they score well on the ESG map, right? Because it's easy to say, look, we focus on ESG, but how do you dive deep when you do that analysis that, you do in fact score well on these models?
I would say we start with a perspective that we should be clear about what we're assessing. There's a difference between companies' operational impacts and risk from an ESG perspective and the impact of their products from an ENS perspective. So you could imagine a solar panel company, for example, where you would say, well, clearly that's a green product that has an environmental benefit. But the way in which they manufacture that product may not necessarily have strong environmental standards or social or governance practices. So from our perspective, we want to separate those two things, look at them through each respective lens, and then work with each client that we may engage with around, what are your preferences? What are your overall objectives? How can we align this with your wider investment beliefs? And the resulting approach then is, are you going to be quite, let's say, exclusionary in the way you might take a binary decision to include or exclude companies based on your preferences? Or do you want to be more nuanced? Try and maintain broad market exposure. Try and achieve an investment experience similar to, let's say, the underlying index universe, but reweight within that using some of the characteristics that we might take from either side, the product side or the operational side.
Right, we have the investor demand that's certainly there. Are you seeing it translate into flows? Or people like putting their money where their mouth is?
Yeah, absolutely. I think, from two dimensions, I think it's fair to say institutional is sort of leading on this, and we see particularly some of the largest asset owners globally. But retail will be very, very quick to follow, both in breadth and level of sophistication, I think it's fair to say. And in fact, adopting many of the sort of learnings and techniques that the institutional space may maybe have refined over the years.
Right. Well, Alec, let's go back to you. Do you think that this is simply a trend or something that's going to be long-term and sustainable?
No, I think this is very much long-term and sustainable, and maybe going back to some of those drivers that I mentioned earlier, things like increasing technological power and access to data. Those are the kinds of things that are going to make refining the way you can screen companies easier and easier to do. And obviously climate change, I think, is a long-term imperative. So no, I don't see this going away. If anything, I think eventually you're going to be able to do to a ESG-oriented index what you can do to a cap-weighted index today. So you could look at low volatility ESG or high beta ESG or high dividend paying. So I think it'll all evolve, and eventually I think the Russell 1000 or the Russell 2000 or the S&P 500, those indices will all be ESG.
Right.
I think you won't be able to have a broad market index in 30 or 40 years that doesn't incorporate a lot of these factors.
It's almost like MiFID II. If you want to be a global asset manager, you have to be on board, right? So it's like unless you have a clear ESG strategy, you're just not going to be a part of the index, or you're just not going to be investable.
Well, I think at the end of the day, investment decision making will be incorporating these issues, right? I mean, all of this is about a broadening out of our conceptual expectation and understanding of risk and opportunity for individual companies and at the portfolio level. You know, I don't really think it's any longer acceptable to close your eyes and ears to the potential that there's financial risk, material financial risk from E&S factors. Now, the challenge lies in figuring out for you, either as a fund manager or as an overall financial institution, what are those risk factors and how are they relevant to you? Because there's not one uniform answer there.
Right.
But it means that, you know, through all these enablers like better technology and more data, improved disclosure, we'll be able to continue to improve our answers to those questions.
Right, and Evan, that's a question I want to follow up with you. What are some of the challenges facing companies in providing data to show ESG compliance?
Well, first and foremost, time, resources, money. I mean, all of the things you hear about, expertise in-house, whether they have the expertise to interpret the data signals and perform and report on them. A lot of companies are confused or unsure about which reporting channels are legitimate and actually derive value for the firm and which ones are sort of more esoteric. Companies at all ends of the chain are being beset with questionnaires and requests for data from lots of different institutions, and some have more low-end or more impact than others. And I think also there's a sense that the business case is still a little bit unproven for companies. Companies want to report, they want to get rewarded by investors for reporting good performance, but they have not necessarily been put to the front of the class right yet. So there's a certain sort of hesitancy about whether or not the ESG performance actually is correlating in terms of some of these investor dynamics that they really want.
Right, so what are some of the solutions that we're working on to help companies make these decisions?
Constant engagement on the business case. So trying to draw the line between ESG performance disclosure and connections with investors, connections with stakeholders, connections with talent, all those kinds of things that have a bottom line impact. Constantly trying to tinker with and improve the calculation methodology so that everything we do is based on data. There's a data performance metric for all of these things that is measurable and trendable over time. This isn't just a, do you have a policy or don't have a policy? This isn't a good feeling. This is something about actually generating returns that are based on facts.
It's amazing how everything just comes back to data,
Yeah.
right?
And I think increasingly the way that this has worked, or I should say historically the way that this has worked, is we're looking at, by and large, non-uniform, voluntarily reported information, right? Companies are the source of the information that's being analyzed. Mm-hmm. One of the pressures that will compel them to improve both the quantity and quality of that disclosure is the fact that other data sources will increasingly feed into investor views, and the companies will want to be able to control that narrative a bit more firmly and to be able to say, actually, we don't want you getting your data from another source that is sort of either a media source or some other industry report. We want you to be coming to us, and therefore the pressure will be to make sure that it's, you know, very valid and clear,
Right, like it all
and
depends.
robust.
Exactly, who's sanctioning this report, or you know, where is it coming from?
And regulatory trends, to Tony's point, are shifting, and that's one of the things that's going to compel companies to disclose more. I know on the ballot next week in Oregon is pricing carbon. They would be the first state to do that. I think eventually that'll be globally universal, and that'll be a big imperative where there's a capitalist incentive to start. That's more strictly on the environmental side. It doesn't really have much to do with social and governance. But speaking environmentally, pricing carbon can be a very big catalyst, and that's a regulatory shift, something that governments require, and that will force companies to really take this increasingly serious and to disclose a lot more data, and it'll allow investors to screen much more effectively because they'll have the government requiring a lot of this information.
From a capital markets perspective, is ESG reporting regulated at this point, or is it still arbitrary?
In some places, there are some exchange rules around it in different parts of the world. There's an EU non-reporting financial directive that trips up some US companies, but it's mostly EU companies. There's Asian corporate governance directives and disclosure rules around annual report, that certain content you have to put in there. But it is still fairly wide open, certainly wide open in the US.
Right, like who's to determine, well, you know, you're part of ESG, you fit that model. For example, like let's look at healthcare. Is there a lot of healthcare actually in ESG, or?
Well, again, it depends on the different dimensions that, that you do want to look at. And I think where, from a disclosure sort of rationale and argument point, the main emphasis is around materiality, right? So the infrastructure and the regulations are already in place that companies should be reporting material risks to their shareholders and the market more widely, right? So then it's really about, to Evan's point, making the case that there exist already today environmental and social issues and governance issues that fit within that definition of materiality that should already be part of those disclosures, rather than requiring some new framework or new obligation to disclose. It's about saying, actually, you know, you should already be providing information that is material and that necessarily shouldn't exclude E&S issues.
Well, and the reason I was asking healthcare, because, okay, let's say, assume a company is doing everything from a regulatory perspective, but then who's to say if depending on your morals or your ethics, does healthcare fit into a space like that? So then I'm using that as an example because how do we decide, you know, what ethically or morally these companies fit into that category? What if I don't think climate change is a big deal, right? So
disclosure isn't about ethics and morals, right?
Right.
It's about providing valuable information to the market. Then it's on to the users to determine their preferences, and many investors would sort of look at this and say, what's financially material is what I want to focus on. And then it's on the investor to make that case. And if there are specific segments of the market that have a particular moral or ethical view or preference, they can build that into their portfolios. But by and large, that's not what's driving ESG integration.
It's the investor at the end of the day that's going to decide whether or not they think that you fit into that category if they're buying or selling it. And is it broad? Is it just millennials that are interested in this segment, or is it more broad than just that?
I certainly think it's broader. Yeah. I mean, certainly the trend didn't start with the millennial generation, right? I mean, I think it's the largest institutional investors in the world that have been leading this, right? And now you have a certain client base that is reflective of shifting consumer preferences across the board, not just in investments, all sorts of things, where they're trying to be more focused and align their consumer choices with their individual values. You'll see that in the investment space. But ultimately, again, what's going to change behavior in the markets is not a moral or ethical dimension and compulsion. It's about the financially relevant environmental and social issues.
Well, let's get some forward-looking thoughts moving into 2019 over the next 5-10 years. What you focus on, what do you think the landscape's going to look like? Is it going to, that focus come back to data? And
yeah, I think it does come back to data. I think you'll find more harmonization, more unification of different frameworks. I think you'll find different frameworks partnering together and working together, at least correlating, if not actually combining. So I think that the landscape will become less cluttered. I think some of these standards will rise to the top, and they will actually become default standards for the reporting industry, and maybe they become written into rules, maybe they become part of the accounting standards, maybe not, but at least it'll get more formalized. And I think that, you know, to Tony's point earlier, in terms of a broadening out of the investor perspective, I think there's been a slight broadening out of the fiduciary responsibility perspective also. So that's why I think it's not just millennials, it's people in companies that are sort of coming to a better understanding of the sources of value, long-term value for their company, besides what we've talked about for 50 years.
Right, and Alec, I'll ask you the same question as well from both of your perspectives. What do you think the industry is going to look like?
I think it's going to be much larger, both in terms of the number of people that are dedicated to following these trends day to day, and also in terms of assets under management that are benchmarked to ESG-oriented strategies. I think it's just sort of up and to the right, pretty much across the board. And things like government regulation will mandate the disclosure of certain data sets. It'll allow investors to screen every company in an index across that one metric. Like, for example, you know, carbon pricing, once that happens, that's immediately material, to Tony's point. It's financially material, and every company will have to disclose that, and it'll be very easy to do a screen of who's scoring well, who's scoring below average, et cetera. So all of these things, I think, are going to be increasing the adoption. And then obviously, as a baseline, technology really enables a lot of it. I think the climate change aspect really drives a lot of it. And those two forces, I think, are technology is only going to get better. Climate change, unfortunately, I think is also here to stay. So I think those are kind of two macro forces that it's hard to see and this doing anything but sort of forge forward over time.
All right, and Tony, final thoughts.
Yeah, I think there's been a constant search for consensus around definitions and standards, not necessarily from a disclosure point of view, because I agree with Evan's point on where that's kind of going, more in a sort of investor approaches and sort of what is or isn't sustainable investment. Personally, I think we've been, you know, in the 14 plus years I've been doing this, that's been a constant theme. I don't think we're going to reach that, and I kind of think it's the wrong question to search an answer for. I think scale will define that in large part, in terms of the largest asset owners, asset managers, and the strategies that they follow will sort of define some of those approaches that become a bit more standardized for ESG integration. And I think one of them that certainly I would expect from a index and passive perspective is being able to build some of these characteristics into the way that you would construct a benchmark, either for the purposes of traditional measurement tool or passive implementation.
All right, it'll be interesting to see how ESG evolves over the next 5 to 10 years for sure. Thank you very much for joining us at MarketSite, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.